Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, and today we have a really fascinating topic for you guys.
We really do. Because, if you want to know if the tech stocks in your 401k are about to just completely crash, the most accurate warning siren isn't actually located in Silicon Valley.
Right, or Wall Street for that matter.
Exactly. It's actually a single hyposensitive stock market like 6,000 miles away in South Korea.
Which, it sounds totally counterintuitive for an everyday American investor to be looking there right now.
Yeah, why is that?
Well, we are currently navigating the Trump administration's economic landscape, right?
Yes, right.
It's heavily focused on domestic growth.
Right, bringing manufacturing back home.
Exactly, bringing it home, ensuring U.S. technological dominance. You look at these big AI software companies or the massive data centers being built in Texas or Ohio.
Yeah, they're huge.
They really are.
Yeah.
And it feels like an entirely American phenomenon. But the underlying reality of the global supply chain, according to recent analysis, tells a completely different story.
Okay, let's unpack this because the contradiction there is just wild to me.
It is.
We have this America First economic push, right? But those same American tech giants are completely fundamentally tethered to hardware components built halfway across the world.
Yeah, absolutely tied to them.
And the numbers we are seeing coming out of the Korean market right now are frankly, they're hard to wrap my head around.
The data is staggering.
It really is. According to recent data, in 2026, the KOSPI index, which for those listening is South Korea's equivalent to our S&P 500, is up over 100% year to date. And on May 6th, it crossed the 7,000 mark for the first time in history.
Right.
For an entire national stock index to double in less than 6 months is, well, it's almost unheard of.
It is unheard of. But you have to look at the concentration of that market to understand how that actually happens.
What do you mean?
So at the time it crossed that 7,000 mark, just two companies, Samsung Electronics and SK Hynix, they made up 44% of the entire market's value.
Wow. Wait, 44%, just two companies?
Just those two. The KOSPI is essentially dragging the rest of the Korean economy upward purely on the back of artificial intelligence memory chips.
Okay, so if those two companies are making the memory chips that American AI data centers completely rely on, is the Korean market basically just acting as a giant financial thermometer for our American tech giants?
What's fascinating here is exactly that. It's how the global financial system has completely repurposed the Korean market.
Repurposed it.
Yeah, because historically, institutional investors viewed South Korea as a gauge for general global manufacturing, like cars, consumer electronics, ships.
Right, heavy industry stuff.
Exactly. But
Okay.
today,
Yeah.
it has transformed into this high-sensitivity indicator for the global AI stress test. Analysts are actually referring to it as a high beta market.
I always hear high beta thrown around on financial news. My understanding is that it just means a stock or a market is more volatile than average, like it swings harder in both directions.
That is the textbook definition, yeah.
Okay.
But let's look at the mechanics of why it swings harder.
Okay.
The companies in Korea are sitting at the absolute choke point of the global AI supply chain.
The choke point.
Right. When investors in New York start to get even slightly nervous about whether these massive investments in AI servers can actually turn a profit.
Or if the infrastructure build-out is slowing down.
Yes, exactly. That anxiety hits the component suppliers first. It is the bullwhip effect.
Oh, I've heard of that.
Yeah, a tiny flick of the wrist in California creates this massive, violent crack of the whip and sole.
And looking at the data, we have absolutely seen that crack of the whip recently. The volatility is stomach churning.
It's been a wild ride.
Right. On June 8th, amidst some fears regarding U.S. job data and interest rates, the Korean market dropped 8.3%. And that triggered a national circuit breaker, which, that means they literally had to halt all trading across the entire country just to stop the panic.
Right, they just pulled the plug for a minute.
And then on June 23rd, it plummeted another 9.99% in a single day.
Think about that. Nearly 10% of a developed nation's corporate value just wiped out between your morning coffee and the closing bell.
Which brings us to a massive disconnect here. Because if this giant thermometer is jumping up 100% and then crashing 10% in a single day, you would assume the underlying business is just incredibly unstable.
You would assume that, yeah.
But looking at the actual companies making these chips, the business of building AI hardware is booming, right? The demand hasn't dropped at all.
No, The underlying fundamentals are arguably stronger than ever.
Right.
The core of this is a technology called high bandwidth memory, or HBM. According to the latest industry reports, SK Hynix recently shipped samples of their next-generation 12-layer HBM4E chips.
Okay, I want to pause and break down what high bandwidth memory actually does for the everyday learner listening because, well, it is the entire bottleneck of the AI industry.
It really is. Go for it.
So think of an AI processor like a world-class genius chef.
Right.
Someone who can cook 100 meals a minute.
Okay, I like this.
Standard computer memory is like a pantry located all the way down the hall from the kitchen. It doesn't actually matter how fast the chef is. He spends most of his time just running down the hall to grab ingredients.
Right, he's wasting time.
Exactly. High bandwidth memory, though, is like building a multi-tiered automated conveyor belt pantry directly around the chef.
Feeding him data the exact millisecond he needs it.
Yes, exactly.
And this new 12-layer generation from SK Hynix that the reports highlight, it isn't just faster delivering those ingredients, it's actually 20% more power efficient.
Which, I mean, that sounds like a nice incremental upgrade, I guess, but 20% doesn't sound like a massive revolution to me.
Well, if we connect this to the bigger picture, it actually is revolutionary. Yeah. AI data centers are currently consuming electricity on the scale of small cities.
Oh, wow.
We are reaching a point where the physical limitation of AI isn't the software anymore. It's whether the local power grid can actually handle the energy draw and the heat generation of the hardware.
Ah, I hadn't thought about the heat.
Yeah, so 20% power saving on the memory side. That is a monumental leap in keeping these data centers operational.
That makes a lot of sense.
And that is exactly why the chairman of SK Group recently announced plans to double their wafer production capacity over the next 5 years. Their internal projections actually suggest memory shortages could last all the way until 2030.
Wait, 2030?
Yep.
They are openly telling the world they cannot build these chips fast enough to satisfy the tech giants for another 6 years.
Yes, and it backed up by U.S. data as well.
Really?
Yeah, look at Micron, the major American memory manufacturer. Their June 24th earnings guidance completely crushed Wall Street expectations. And their data confirmed the exact same timeline. High bandwidth memory shortages could easily last another 2 to 3 years at a minimum. Demand is just vastly outpacing supply.
Here's where it gets really interesting, though. Because when Americans hear Korean tech, they almost universally think of Samsung.
Of course.
Everyone has a Samsung TV or a Galaxy phone or maybe like a Samsung refrigerator.
Right.
But looking at the research, global capital is treating SK Hynix and Samsung very differently right now.
Very differently.
Because there was a story dominating financial media recently about Samsung doing an immediate 90 trillion won stock buyback.
Oh, I remember that.
Yeah. And for context, 90 trillion won is over 60 billion US dollars. That would be a historic amount of cash just handed straight back to Wall Street investors. I assume that drove the stock price insane.
Well, it drove a lot of retail trading, but the data actually clarifies that this rumor was entirely false.
Wait, false?
Yeah, it was a misinterpretation of corporate filings. Samsung is not doing a 90 trillion won shareholder payout.
So what were they actually doing?
What they're actually looking at is utilizing about 10.5% of their semiconductor operating profits for employee stock compensation.
Oh, so they are just paying their engineers and executives in stock.
Exactly.
That is a labor retention strategy, not a giant cash piñata for outside
No,
investors.
not at all. And it really highlights a broader governance issue. It shows why institutional money treats these two giants so differently.
How so?
SK Hynix is viewed by the market as a pure AI play. Their fortunes are almost entirely tied to that high-speed memory conveyor belt you talked about.
Right.
They're aggressively targeting global capital to build more of it, even looking to raise up to $29.4 billion by listing in the U.S. via American Depository Receipts, or ADRs.
Let's define ADRs really quickly. Essentially, it's difficult for everyday American investors or even certain U.S. funds to buy stock directly on the Seoul exchange, right?
Yeah, lots of hurdles.
So a U.S. bank buys a massive chunk of SK Hynix shares, puts them in a vault, and issues receipts for those shares that trade in New York in U.S. dollars.
Precisely. It is a financial bridge to tap into the deepest pool of capital in the world.
Makes sense.
SK Hynix wants U.S. dollars to build more AI infrastructure. Samsung, on the other hand, is a much more complex conglomerate.
Right, the refrigerators and phones.
Exactly. They make AI memory, yes, but they also make all those consumer goods. Plus, they navigate a very complicated corporate governance structure internally.
Ah.
So if an institutional investor wants the pure temperature of the AI boom, they look at SK Hynix.
Okay, let me synthesize this because there is a glaring contradiction we need to solve here.
Okay.
We have established that the technology is fundamentally strong. They are making chips that are 20% more efficient. Demand is secured until 2030. The companies are aggressively expanding.
All true.
So why did the entire market crash 10% on June 23rd? If the business of AI hardware is perfectly fine, what actually caused the panic?
The answer lies in how people were buying the stock, not the stock itself.
What do you mean?
The hidden amplifier here is retail leverage.
Ah, leverage. For the everyday investor listening, leverage just means borrowing money to buy stocks. We often call it trading on margin.
Exactly.
You have $10,000, you borrow another $10,000 from your broker, and you buy $20,000 worth of stock. If the stock goes up, your profits are doubled. But if it goes down,
Things get ugly fast.
yeah, very sass.
And according to recent analysis, by late May, Korean retail investors had poured over 60 trillion won into leveraged stock investments.
60 trillion won.
Yeah, that is roughly 43 billion US dollars of borrowed money injected directly into everyday trading accounts.
Wow. I want to visualize how margin creates a market crash for people.
Sure.
It's kind of like holding a microphone too close to a speaker.
Oh, I see where you're going.
When you do that, a tiny background noise gets picked up by the mic, played through the speaker, picked up by the mic again, and amplified until you get this massive screaming feedback loop.
That horrible screeching sound, yeah.
Exactly. With margin trading, if the market drops just a tiny bit on some normal economic news, brokers get nervous. They issue a margin call, demanding the investor deposit more cash to cover the borrowed money.
Right. And if the retail investor doesn't have the cash just sitting around,
Which they usually don't.
right, then the broker automatically sells the stock to get their loan back.
Right. So now you have thousands of forced sales hitting the market at the exact same time. That pushes the stock price down even further.
Which triggers a second wave of margin calls.
Exactly. For other people.
Yeah.
Which causes more forced selling. The microphone screeches, the feedback loop takes over, entirely detached from the actual value of the memory chips being sold.
And Korean financial authorities actually saw this doom loop forming.
Cool.
Yeah. On June 22nd, they issued a rare public warning about the rapid expansion of leveraged exchange-traded funds. They basically saw the microphone getting too close to the speaker.
And the very next day.
The very next day, the market dropped 9.99%.
So the June 23rd crash wasn't a signal that the AI cycle is dead at all.
Not at all. The demand didn't vanish. The structural integrity of the AI chip market was completely intact.
It was just the leverage.
Yes, it was the financial scaffolding built around the market that collapsed under its own weight.
Right.
When trading positions become that crowded with borrowed money, the underlying fundamentals of the companies no longer dictate the daily stock price. The margin calls dictate the price.
That distinction is incredibly important. The hardware business is fine. The trading behavior was just reckless.
Exactly.
And frankly, a market where $43 billion in retail margin debt can trigger a 10% single-day crash sounds a bit like a casino.
It does.
Which perfectly explains a recent decision by MSCI that was in the data.
Oh, yes.
MSCI is a major global index provider. Think of them as the gatekeepers who decide which countries get classified as safe, mature places for trillions of dollars of pension funds to invest.
Right, the big money.
And in June 2026, MSCI officially decided not to upgrade South Korea to developed market status. They are keeping them labeled as an emerging market.
Which is a heavy blow considering the advanced state of their economy.
My initial thought when I saw that was that MSCI just doesn't trust the tech boom. Like, if South Korea is the absolute heart of the global AI hardware supply chain, why are they stuck at the kids' table of global finance?
Yeah, but this raises an important question about how institutional money actually moves. It really has nothing to do with trusting the tech.
No?
Not at all. Think of the Korean market as a brilliant state-of-the-art smart home.
Okay.
It has solar panels, the latest AI assistants, incredible architecture.
Yeah.
That represents their tech dominance.
Sounds nice.
But if you try to take a shower and the pipes rattle and the water only runs for a few hours a day, you have a major plumbing problem.
I get it.
MSCI's issue is entirely about financial plumbing. It's about market accessibility.
So what exactly does bad plumbing look like to a $1 trillion Wall Street fund?
According to the official reports, the issues keeping them out of the developed market club are highly technical. The biggest hurdle is actually the currency. The Korean won is not fully tradable 24 hours a day offshore.
Let me put myself in the shoes of a U.S. fund manager here. Let's say it's 3:20 a.m. in New York. A massive geopolitical crisis hits, and I need to immediately sell $1 billion worth of Korean stock and convert it back to U.S. dollars to protect my clients.
Okay, realistic scenario.
If the offshore currency market is closed, what happens?
You are trapped.
Wow.
You might be able to sell a stock in local hours, but you can't freely convert the currency when you actually need to globally. Institutional investors just cannot tolerate that kind of liquidity trap.
That makes total sense.
Furthermore, the settlement infrastructure, like the actual legal mechanics of transferring ownership of a stock, is considered pretty clunky and outdated for the speed at which global funds operate.
So it's pure friction. The pipes are just too narrow for the sheer volume of water Wall Street wants to pump through them.
Exactly. There are also heavy complexities regarding short selling, which large funds use to hedge their risk. If they can't hedge properly, they simply won't invest.
Right.
The current setup just has too much operational risk for MSCI to give them that top-tier status.
But the Korean government isn't just ignoring this, right? I mean, getting that developed market status would force passive global index funds to automatically dump trillions of dollars into their economy.
Oh, they are highly motivated to fix it.
Hmm.
The government has set aggressive targets for 24-hour trading of their currency and better offshore settlement mechanics by 2026 and 2027.
Okay, so it's a delayed timetable, not a permanent rejection.
Right. They are actively working to replace those rusty pipes.
So what does this all mean? We've navigated a lot today, from the power efficiency of HBM chips to the doom loops of margin trading and the plumbing of global finance. Let's distill this into something the everyday American learner listening can actually use.
I think there are three main takeaways here.
Lay them out for us.
The first takeaway for your own portfolio is to separate the core from the noise. The AI boom isn't over just because a major tech index dropped 10% in a day.
Right.
The physical shortage of memory components is very real, and the companies building them project those shortages to last for years. You have to look past the daily volatility to see the underlying technology shift.
Like we said earlier, the Gordon Ramsay kitchen is still being built, and the restaurant is fully booked until 2030.
Love that analogy.
Oh.
Second, beware of leverage. The wild market swings we are analyzing are driven by crowded trades and borrowed money.
Yes.
When you see extreme volatility, remember that it is often the mechanical structure of trading like forced margin selling driving the price, not a sudden flaw in the company's business model.
If the microphone gets too close to the speaker, step back and cover your ears until the feedback loop stops. Don't panic sell your own solid investments just because someone else is getting margin called.
Exactly. And finally, use Korea as your early warning radar. Even if you don't own a single international stock, if you hold U.S. tech giants, you are tethered to the Korean supply chain.
You really are.
A crash there due to leverage or supply constraints is your earliest signal that the global AI trade might be overheating. Watch the high beta thermometer to understand the true temperature of your domestic portfolio.
That really shifts the perspective from looking at your portfolio in a vacuum to seeing the entire global board.
It really does.
I want to leave you with a final thought to mull over today. If the entire global AI infrastructure, from the massive software platforms deployed by the U.S. government down to the microscopic memory chips, relies so heavily on the power grids and trading mechanics of just a few concentrated regions like South Korea, what happens when the next wave of AI requires twice as much power and twice as many chips?
That is the big question.
Will the physical geography of the tech world have to fundamentally shift to keep up with that demand? Something to think about as you review your investments this week. Don't forget to subscribe and hit that like button.